The suicide clause for the national portion of the insurance exam is a provision that dictates exactly how a life insurance company handles a claim when an insured takes their own life. On the exam, you must focus on the timeline because the insurer's financial obligation changes entirely based on whether the death occurs before or after a specific 2-year window. This provision is designed to protect insurance companies against adverse selection, which is the tendency of people with a high risk of loss to seek insurance. In this specific case, the clause prevents an individual from purchasing a large life insurance policy with the pre-existing intent of committing suicide to provide a financial windfall for their family. For the first 2 years after the policy issue date, the insurance company is not required to pay the face amount or death benefit if the cause of death is suicide. Instead, their only obligation is to return the total amount of premiums paid by the policy owner up to that point. It is vital to remember for the exam that the insurer does not keep the money, but they also do not pay interest on those returned premiums. You will often see a trick question suggesting the beneficiary receives the premiums plus interest, but the standard rule is simply the return of premiums paid once the policy has been in force for more than 2 years. The suicide clause effectively expires and suicide is then treated like any other death. If the insured dies by suicide after the 2-year period, the insurance company must pay the full death benefit to the beneficiary. This 2-year period is a hard cutoff. If a question describes a death occurring 2 years and 1 day after the policy date, the full benefit is paid. If it is 1 day before the 2-year mark, only the premiums are returned. You should also be aware of how this clause interacts with other policy features. For example, if a policy owner lets their policy lapse and then reinstates it, the 2-year suicide clock often resets, starting from the date of reinstatement. This is a common trap on the national exam where a question might describe a policy that was originally purchased 5 years ago, but was reinstated only 6 months before the suicide. In that specific scenario, the claim would likely be denied and premiums returned because the new 2-year window had not yet elapsed. Another significant area of confusion on the exam involves the accidental death and dismemberment rider. Even after the 2-year suicide clause has expired and the base policy pays the face amount, an accidental death rider will never pay its additional benefit for a suicide. This is because suicide is by definition an intentional act and never meets the legal definition of an accident. When you are looking for a mnemonic to keep this straight, remember the phrase, 2 years of premiums, then the full benefit begins. This helps you visualize that the first 2 years only yield what was put in, while everything after yields the full face value. Do not confuse this with the incontestability clause, which prevents an insurer from denying a claim based on application misstatements after 2 years. While both clauses use a 2-year limit, the suicide clause is exclusively about the cause of death and remains the primary defense for insurers during that initial period of coverage. By mastering the timing, the refund rules, and the impact of reinstatement, you can navigate any suicide clause question the exam throws at you. Focus on the dates provided in the exam scenarios and always verify if the policy was recently reinstated, as that is the #1 trick used to catch students off guard. Understanding that this clause is meant to protect the insurer's solvency and prevent fraud will help you remember why the rules are so rigid regarding the return of premiums versus the payment of the face amount. Always double-check if the question asks what the beneficiary receives versus what the insurer is liable for, as the return of premium is the standard liability during that initial exclusion window. In terms of evidence, the burden of proof is on the insurance company to demonstrate that the death was indeed a suicide if they wish to deny the death benefit during the exclusion period. If there is any ambiguity or if the cause of death is ruled accidental, the insurer must pay the full benefit even within the first 2 years. This is why you will often see questions about an unwitnessed fall or a car accident where the insurer tries to claim suicide but fails due to lack of proof. For the purpose of the exam, however, if a question states the death was a suicide, you simply apply the 2-year rule.